After an all-night meeting on December 10th, 1930, the other bankers, including in particular John Pierpont Morgan, refused to subscribe to the guarantee fund, and the plan was off. The next day, the Bank of the United States closed its doors, never again to open for business.
The hypothetical scenario of a mass bank run. What happens if everyone withdraws their cash? Imagine a scenario where everyone decides to withdraw all their cash from banks simultaneously. This hypothetical situation, known as a mass bank run, poses numerous questions about the stability and functionality of the banking system.
I was just talking to old man Potter, and he's guaranteed cash payments to the bank. The bank's going to reopen next week.
But, George, I got my money here.
Would banks have enough cash to cover all withdrawals? What would be the immediate and long-term impacts on the economy? This video explores the ramifications of such an event, examining the underlying mechanisms of banks, the role of central banks, and the potential disasters that could unfold. To understand the impact of a mass bank run, it is essential to comprehend how banks operate. Banks do not keep all deposits as cash on hand. Instead, they use a fraction of deposits to make loans and investments, a practice known as fractional reserve banking. This system allows banks to generate profits and support economic growth by lending money to individuals and businesses. Under fractional reserve banking, banks are required to keep a fraction of their deposits in reserve to meet the withdrawal demands of their customers. The reserve requirement ratio varies by country and is set by the central bank. For example, in the United States, the Federal Reserve requires banks to hold approximately 10% of their deposits in reserve. This means that if a bank has $1 billion in deposits, it must keep $100 million in reserve and can lend out the remaining $900 million. Banks rely on the assumption that not all depositors will withdraw their funds simultaneously. This allows them to use deposits to generate loans and investments. However, if too many customers attempt to withdraw their money at once, a bank may face liquidity issues. Liquidity refers to the ability of a bank to meet its short-term obligations, while solvency refers to the ability to meet long-term obligations. A liquidity crisis can lead to a solvency crisis if a bank is forced to sell assets at a loss to meet withdrawal demands. The immediate impact of a mass bank run. If everyone decided to withdraw all their cash from banks at the same time, the immediate impact would be severe. Banks would quickly run out of physical cash, as they do not keep all deposits as cash on hand. The reserve requirement ratio ensures that only a fraction of deposits is kept in reserve, meaning that banks would be unable to meet the withdrawal demands of all their customers. Banks would face significant cash shortages as they attempt to meet the withdrawal demands of their customers. Most banks do not keep large amounts of physical cash on hand, relying instead on electronic transactions and interbank transfers. As customers line up to withdraw their funds, banks would quickly exhaust their cash reserves, leading to long lines, panic, and frustration among depositors. As banks deplete their cash reserves, they would be forced to sell assets to meet withdrawal demands. This could include selling loans, investments, and other financial instruments at a loss. The rapid liquidation of assets would erode the capital base of banks, leading to insolvency. Insolvent banks would be unable to meet their long-term obligations, resulting in bank failures and closures. The immediate impact of a mass bank run would extend beyond the banking sector, causing widespread economic disruption. Businesses rely on banks for loans, lines of credit, and payment processing. As banks face insolvency, businesses would struggle to access the capital needed to operate, leading to layoffs, bankruptcies, and a sharp decline in economic activity. Consumers, unable to access their funds, would cut back on spending, further exacerbating the economic downturn. The role of central banks. Central banks play a crucial role in maintaining financial stability and managing the money supply. In the event of a mass bank run, central banks would be expected to intervene to prevent a complete collapse of the banking system and the broader economy. Central banks act as lenders of last resort, providing liquidity to banks facing short-term funding shortages. In a mass bank run scenario, Central banks would likely inject large amounts of liquidity into the banking system to help banks meet withdrawal demands. This could involve lowering reserve requirements, providing emergency loans, and purchasing assets from banks. Central banks use monetary policy tools to manage the money supply and stabilize the economy. In response to a mass bank run, central banks could implement expansionary monetary policies, such as lowering interest rates and engaging in quantitative easing, to increase the money supply and stimulate economic activity. However, these measures could also lead to inflation if not managed carefully. Deposit insurance schemes, such as the Federal Deposit Insurance Corporation, FDIC, in the United States, are designed to protect depositors in the event of bank failures. These schemes provide a safety net by guaranteeing deposits up to a certain amount, reducing the risk of panic and bank runs. However, in a scenario where everyone withdraws their cash, the capacity of deposit insurance schemes could be overwhelmed, leading to significant financial losses for depositors. The long-term impact of a mass bank run depend on the severity of the crisis and the effectiveness of the response by central banks and governments. The potential consequences include a prolonged economic recession, changes in the banking landscape, and shifts in monetary policy. The immediate economic disruption caused by a mass bank run could lead to a prolonged recession. Businesses would struggle to access credit, leading to layoffs and bankruptcies. Consumer confidence would be severely damaged, resulting in reduced spending and investment. The collapse of banks would erode trust in the financial system, making it difficult for the economy to recover quickly. A mass bank run could lead to significant changes in the banking landscape. Insolvent banks would be forced to close, resulting in a consolidation of the banking sector. Larger, more stable banks might absorb smaller, weaker banks, leading to increased concentration and reduced competition. This could have implications for consumers, such as higher fees and reduced access to financial services. The crisis would likely prompt central banks and governments to reevaluate their monetary policies and regulatory frameworks. This could include stricter regulations on bank reserves, increased oversight of financial institutions, and reforms to deposit insurance schemes. Central banks might also explore new monetary policy tools and frameworks to enhance financial stability and prevent future crises. Recent studies and historical precedents. To understand the potential impact of a mass bank run, it is useful to examine recent studies and historical precedents. While there has never been a scenario where everyone withdraws their cash simultaneously, past bank runs and financial crises provide valuable insights. The Great Depression. The Great Depression of the 1930s is a historical example of widespread bank runs and financial instability. During the early years of the Great Depression, thousands of banks failed as panicked depositors rushed to withdraw their funds. The collapse of banks exacerbated the economic downturn, leading to widespread unemployment, poverty, and a prolonged recession. In response, the U.S. government implemented significant banking reforms, including the establishment of the FDIC to restore confidence in the banking system. The 2008 financial crisis. The 2008 financial crisis is a more recent example of a banking crisis that had severe economic consequences. The crisis was triggered by the collapse of Lehman Brothers and the subsequent panic in the financial markets. While there were no widespread bank runs, the crisis exposed the vulnerabilities of the banking system and led to significant government interventions, including bank bailouts and monetary stimulus measures. The crisis highlighted the importance of financial stability and the need for robust regulatory frameworks. A 2023 study by the International Monetary Fund, IMF, examined the impact of bank runs on financial stability and economic growth. The study found that bank runs can lead to severe liquidity shortages, asset fire sales, and insolvency. It emphasized the importance of central bank interventions and deposit insurance schemes in mitigating the impact of bank runs. The study also highlighted the role of public trust and confidence in maintaining financial stability. Another study conducted in 2024 by the Bank for International Settlements, BIS, explored the effectiveness of various monetary policy tools in responding to bank runs. The study found that timely and decisive interventions by central banks, such as liquidity injections and asset purchases, can help stabilize the banking system and prevent a broader economic collapse. However, the study also cautioned that these measures must be carefully managed to avoid inflation and other unintended consequences. To sum up, a mass bank run, where everyone withdraws their cash from banks simultaneously, would have catastrophic consequences for the banking system and the broader economy. Banks operating under the fractional reserve banking system would quickly face liquidity shortages and insolvency. The immediate impact would include cash shortages, bank failures, and widespread economic disruption. Central banks would play a crucial role in mitigating the crisis by acting as lenders of last resort, implementing monetary policy measures, and ensuring deposit insurance schemes are effective. However, the long-term impact would depend on the severity of the crisis and the effectiveness of the response. The potential disasters and consequences extend beyond the financial and economic realms, with social, geopolitical, and technological implications. Rebuilding trust and confidence in the financial system would require significant reforms and a commitment to transparency and stability. While a mass bank run is a hypothetical scenario, examining its potential impact highlights the importance of maintaining financial stability and the need for robust regulatory frameworks and contingency plans. By understanding the vulnerabilities and risks, policymakers, financial institutions, and the public can better prepare for and mitigate the effects of such a crisis. Thank you for watching.